We are taking a look at equity option implied vol and credit spreads, that relationship. Joining us now is Steve Laipply. He's the Managing Director and Head of U.S. iShares Fixed Income Strategy of BlackRock. Thanks so much for coming on their show and for helping us out with a panel at RMC this year.
Thanks for having me.
So tell me about this relationship. What do you see happening here?
Well, so I think the broad message of the panel is that credit markets have started to evolve in a very rapid way. And so a lot of times when we look at the fixed income markets relative to the equity markets, it can be a little bit frustrating because it seems like the progression has been happening a little more slowly than we would like. But I would say in the last 3 to 5 years, that's changed quite a bit. So the maturation and significant uptick in usage of bond ETFs, as an example, has significantly changed the way investors are trading and managing credit risk. There have been a number of very interesting developments that have come alongside of that, such as electronic trading in credit and also ancillary derivatives markets around those bond ETFs. And so, as we look at the relationship across markets, the tools that are now coming online and becoming more actively used are really shedding light on some of these relationships that in the past have been a little bit harder to see. So you now have investors that have an entire toolkit at their disposal. So they have the underlying cash bonds, they have the ETFs, they have derivatives on those ETFs, and that toolkit allows them to make very efficient judgments as far as how they manage risk, both within credit itself as well as versus other markets such as equities. Investors
also have corporate index bond futures.
That's correct.
Brought to you by Cboe, BlackRock, and IHS Markit. How's that going and what are the advantages there?
So this is a very exciting development in the ecosystem. Having a futures contract that's visible, listed, and transparent is a real benefit for credit investors. The benefits that we see to it is that it's a standardized contract. It sheds light into the underlying carry in those markets and allows investors to make informed judgments on whether they should be long or short that risk and what's the most efficient way to put it on. So futures contract will help provide a lot more transparency, even beyond our existing ETF ecosystem.
What would you say is the biggest takeaway from your panel?
I think the idea that relative to even 5 years ago, credit investors, like equity investors, now have a lot more in their toolbox to help manage risk. It's going to benefit end investors tremendously because all of this efficiency means that investors are realizing more of their return. Efficiencies are driving trading costs lower, and that's all good for our end investors. So the more tools you have, the more transparency and the more efficiency you have.
Well, thanks so much for sharing those strategies.
Thank you.